All right, buddies. So we're discussing, what do you say, depreciation. So let's continue with it. Okay. Some of the rules of depreciation we'll see, which most of it you may know, but still revision. Because there are some hidden points which we need to know, obviously. So that's why we have to do all these things. Block of assets done. So what are the interesting things? Most important condition is the asset must be used for business or profession. So it has to be used for business or profession, nothing else. Right? You cannot use it for personal purpose. It should be used for business or profession. Now, it can also mean that some of the assets may be, what do you say, at your director's place. Ultimately, it will be treated as a business expenditure. You have to think about it like that. SSE must be the owner of the asset without a doubt. The SSE must be the owner. What type of owner? Beneficial owner of the asset. Right? So first of all, it should be used for business or profession. And secondly, SSE must be the owner. And what owner? Beneficial owner of the asset. The only exception is deemed building. Is he, when I say beneficial owner, what do you mean by that? It may be used by somebody else, but ultimately the benefit will go to him. Right? So the thing is, I not only own it, but all the benefits go to me. For example, if I have a house, I'm just giving an example of beneficial ownership. I have a house and then I give it on rent. Okay. But then I'll tell, okay, rent, let my children keep the rent, no problem. The rent is going to my children, okay. But ultimate benefit of ownership belongs to whom? Me. Tomorrow, if I sell the house, money will come to me. Rent also will come to me. I'm applying it to my children. So the registered owner will have all the benefits of ownership. So first and foremost, SSE must be the owner. What type of owner should he be? Beneficial owner. The only exception to this is team building. In team building, as we already discussed, SSE is not the owner. SSE is the tenant, but is still getting the, what do you say, depreciation on the asset. Then one more example, Mr. A, he has a fleet of cars. He has cars which is B, C, D. He has a fleet of cars. All these cars he has. These cars are registered as per the Motor Vehicles Act. In whose name? Registration is in B, C, D, E, F's name. Okay. So father has bought 5 cars for his 5 children. Each car is registered to his child. So the registration wise, it belongs to whom? So Mr. A, fleet of cars, B, C, D, E, F. So the Motor Vehicles Act, registration is in whose name? B, C, D, E, F. The next question is, just because it is registered in your name, does it make you an owner? Just because it is registered in your name, does it make you an owner? Is registration a measure for ownership, or registration is not a measure for ownership? It went to the court. In many cases, they have told that registration, as per the Motor Vehicles Act, is not at all a measure for ownership. Here, tell me, who is the real beneficial owner? Okay, it may be registered in my children's name. Okay, but who paid the money? I paid the money. I own the fleet of cars. Registration can be in somebody else's name. That's okay. Ultimate ownership is mine. I am the owner behind the entire drama that I have created. Right? So, what matters, my dear friends, is the beneficial ownership, not registered ownership. Right? So, I have leased my building to you for 20 years. I am the lessor, you are the lessee. I am the owner of the building, I have leased it to you for 20 years. Who can claim depreciation, lessor or lessee? This also was a question. Lessee went and told, sir, I am actually the owner of the property almost because I have it for 20 years. Court said no. As per Income Tax Act, the depreciation should be only and only the lessor's responsibility, not the lessee. But there is an exception, that is hire purchase. In hire purchase, a hire vendor will give the asset to you on hire purchase. So the depreciation will be claimed by hire vendor or hire purchaser. The hire purchaser will get the ownership of the asset only on payment of the last installment. Only on payment of the last installment. But still, as per Income Tax Act, that's an exception. Otherwise, nobody will go for hire purchase. They will see the tax benefit also. No, that's right. The tax benefit of hire purchase is what? The depreciation. Hire purchaser will give the will get the depreciation. So hire purchaser is deemed to be the beneficial owner here. He will get depreciation from the beginning. Interesting point. Hire vendor actually has to get, but it's an exception as I told you. All other rules who will get hire, the owner will get. But in this particular case, who will get? Hire purchaser will get. Simple. And depreciation should be from the beginning. Then, as regards depreciation is given for ready to use method or put to use method. Very simple. Maybe in Companies Act, etc., it is ready to use. Whereas in Income Tax Act, it is the put to use method. So if I bought a AC and just kept it without using, then is it ready to use or put to use? Ready to use. Can I claim depreciation? No. Only when I install it, it will be put to use. By that logic, what about fire extinguisher? Fire extinguisher is actually ready to use always, but I have never put to use. I will put it to use only in that very unfortunate and unexpected and undesirable condition of then there is a fire. So will it be allowed as a deduction of depreciation in the year of fire, or it is allowed if it is ready to use? So there are certain exceptions. An additional generator set, fire extinguisher, these are, even though ready to use, is called as passive use. Generally, you should have active use. If I have a asset, actually I was seeing here, no, I have a, what do you say, printer. Printer, I just bought it recently, Canon printer. It is ready to use. I have not put to use. So for example, this printer, I see. This printer which I bought, Canon, whatever it is. So is it ready to use or put to use? Ready to use. I have not been able to install it only. So can I claim depreciation on that? No, because it's not put to use. But if I buy a fire extinguisher, even though it is not put to use, if it is just ready to use, is it, can I claim depreciation? Answer is yes. So in that, for fire extinguisher, they use the concept of passive use. In the printer example, it has to be active use. Actively I should use it. But in fire extinguisher, it is the concept of passive use. If you are able to use that properly, or even if it is worthy of being used someday, then it is called passive use. So fire extinguisher, then your extra, what do you say? This thing, what do you say? Extra generator set, which I've kept. All these are examples of passive use, where you can definitely get depreciation. On the other hand, for normal assets like printer, etc., it has to be active use, where I actually have to put it to use. Simply it lying over there will not serve the purpose, right? Simple. So Companies Act, ready to use. Put to use, Income Tax Act. Active use, normal. Passive use, fire extinguisher, generator set, a spare UPS. All these are passive use. Definitely it will be, you will get the depreciation. This is regarding depreciation. Then in depreciation, there's a concept. If you see depreciation, you can read all these things here. Same stuff is given. Whatever I spoke about leasing, whatever I spoke about possession, usage, control is given here. Passive use, potential use given. Same thing only I'm doing. So once we do the class, you read the notes, you will get extremely good clarity. Because there in more simple words I've explained with examples, etc. They must be put to use. Right? So we're going that way only. So once the depreciation you pick it up today and you study, you'll understand everything. So depreciation is a concept which we learn in inter only, but in final higher level has to be done. And my inter classes will be final level only. That's why I'm actually doing the revision from inter material, not this. The whatever I wrote down, no, that is the inter students I teach them. I teach them the depth of final only. Needed, right? So these are some of the very good examples of active use, passive use. Are you with me, all of you guys? Yes or no? Are you able to understand? Let me know. Guys, are you there? Yes. Okay. Cool. Done. Next, coming to the class of assets. So class of assets, I can divide it into four main classes. We have building, furniture, plant and machinery, intangible asset. Building can be roads, wells, even footpath. If you take an entire structure, an area where various buildings are there, roads are connected. In the side, there is a borewell also. Is borewell also part of the building? Yes. Building includes roads, actual building, footpath, well, anything. So building is the main class of asset. Then we have furniture. Furniture includes what? Electrical fittings. Buildings we have what? Road, well, footpath, etc. Furniture will include what? Electrical fittings. Plant and machinery, normal plant and machinery. Fourthly, intangible asset. Intangible asset means what? You have patent, copyright, trademark, intellectual property, etc. Now, till 2020, goodwill also was part of the intangible asset concept. But in the year 2020, they removed goodwill from the intangible asset concept because goodwill cannot be measured. The problem happened in the intangible asset. Will you take depreciation? Yes. If I ask you, what is my goodwill? What is the value that I'll fix? I don't know. What is the value of your goodwill? Don't know. If I purchase somebody else's goodwill, then I can have a value. But if it's self-generated goodwill, there will be no value. So, self-generated goodwill, people were valuing whatever the hell they felt like valuing. Instead of valuing it for 1 crore, they were valuing it for 50 crore and claiming depreciation on 50 crore. And Nirmala madam asked, how is it 50 crore? I said, yeah, it's like that only, self-generated goodwill. It was creating lot of problem because of claiming higher depreciation on self-generated goodwill. Tax component was becoming less because profit was becoming less. Many things went to court, and court said self-generation generated goodwill cannot be valued properly. And they said yes, there is depreciation on goodwill is possible, including self-generated goodwill. See, purchase goodwill, no problem. I will value your business at 20 crore, I will buy it over, no problem. But what about self-generated goodwill? There was a Supreme Court decision which said yes, goodwill depreciation is allowed on goodwill. Income tax department did not like this. In the year 2020, what did they do? They removed goodwill from intangible asset. Deadly. And till then, whatever goodwill was there, they said, please compute as if goodwill is a separate asset from the block of assets and remove it from the block only. 2020 old. So till that time, already goodwill component was inside. No, they said remove everything. I don't want it. And from that year onwards, there is no concept of goodwill. Means depreciation on goodwill, no concept exists. Goodwill is not an intangible asset. Patent, copyright, trademark, IP, etc. IPR, intangible asset. Yes, goodwill is not an intangible asset. Right? Goodwill may be an intangible asset for normal discussion purposes, but goodwill is not an intangible asset for income tax purposes. Can you claim depreciation on goodwill? 100% no. This is regarding the class of asset. Alright, guys. So in that there are various subclasses. You need to follow that. Now, as I told you, building includes all these things. What about temple, mosque, church, meditation room, yoga room? All this some companies will have. Now, this is it. Does it qualify as goodwill or it doesn't qualify as goodwill? Is something that we need to understand. So, temple, mosque, church, yoga room, meditation room, whatever these things, even though it is used for recreational purposes, it brings out the faith, it brings out something nice from the employees. In turn, they will work well, or they may leave the company. They'll get enlightened and they may leave the company, but ultimately, it's used for business. So, Supreme Court said temple, mosque, church, or anything which is there for recreational purposes is deemed to be use of business. Supreme Court said that in one of the cases. So can I claim depreciation on that? 100% yes. Coming to the method of depreciation. If you are in the generation or distribution of power, you can opt for SLM or WDV. It is your option of the SSE. option of the SSE. Generation or distribution of power, SLM or WDV are the option of the SSE. If it is any other SSE, then it is always WDV method. So if it is generation or distribution of power, SLM or WDV, it's the option of the SSE, no problem. But it's always the option of the SSE, mind you. But if it's any other SSE, it's always WDV method. So coming to the rates of the, so basically guys, we need to see the only SLM method is what? Generation or distribution of power. The option of the SSE, only that you can go for straight line method. All other cases, it will be different. Rates of depreciation. Building, furniture, intangible assets, plant and machinery, all these things. What are the rates? So it's given in this page here, B12. I've given everything, but anyway, the gist of the story. Building, the residential building, staff quarters, guest house, 5%. General building, 10%. Temporary building, 40%. Furniture, 10%. Intangible asset, 25%. Plant and machinery. Motor vehicles used in hiring business, 30%. Other cases, 15%. Ships, 20%. Aircraft, 40%. Computer and computer software, 40%. But guys, later they said computer software is also not an asset. It can be charged as an expense, as a royalty. So computer and computer software international taxation, they said computer software can be used as royalty. Books and periodicals, 40%. So will you get depreciation on computer software? No. Books, periodicals, professional library, 40%. Pollution control equipment, 40%. Windmills installed before 1/4/2014, 15%. After 1/4/2014, 40%. Oil wells, 15%. Other plant and machinery, 15%. So if you want to understand about the computer software, come here. Take this part. So here if you see this part is now defined as royalty. So computer software will be any computer program recorded on disk, tape, perforated device, anything for that matter. So computer software now is very, very clear. It is excluded from the depreciable asset definition because computer software is not now royalty. We will see this in international taxation when we check royalty definition. International tax, when we check royalty definition, we will see this. Right? Every big company will have a water treatment system. Infosys started it initially. So from all the toilets, etc., whatever the dirty water goes, there is a water treatment plant which will treat the water, and the remaining water, no, whatever it is, clean water will go towards the landscaping. All the garden, etc., is through this water. So there's huge, you have to invest crores in that water tanker, water desalination, demineralization, purification. Can I claim depreciation on that also? Yes, why not? That is part of your machinery. Very much part of your machinery. You can claim depreciation on that without fail. These are all the block of assets. So basically, if you come to this block, tangible asset will be one main block, buildings, machinery, plant, furniture. Intangible asset will be other block. If I split into this will be the blocks: furniture, building, plant and machinery, patents. Just because the depreciation rate is the same, they will not come under the same block. For example, medical equipment and books cannot be in the same block just because they have the same rate of 40%. Should take it in different blocks. So technically, main blocks are tangible, intangible. In that, the main blocks are building, furniture, plant and machinery. Then you have intangible asset. And in this, there are many mini blocks. Temporary structure, 40%. What is temporary structure? Like when I want to construct a building, I will have a temporary structure of 4-5 with asbestos sheet and all those things. No? It's just for construction, I'm using it so that the workers can sleep there. On that also, I can claim depreciation. How much? 40%. So yeah, for building, there are three blocks: 5, 10, 40. Plant and machinery, five blocks: 5, 20, 15, 20, 30, 40, 45. 45 is no longer there now, four blocks. Furniture and fittings, one block. Intangible asset, one block. So there are two categories: tangible, intangible. Four major blocks: building, plant and machinery, furniture, intangible asset. And in that, various blocks: 3, 4, 1, 1. This is the thing. Beyond that, everything will come under this. All the assets in that particular block will be clubbed. Additions, deletions, all those things will continue. Now, theater building, you have these recliner seats, etc. Can I use it as plant and machinery or will it be building? I mean, the recliner seats will be obviously furniture. It can't be machinery, it will be furniture. I'm talking about the building. Entire theater building, can I use it as a plant because I am using it for my business, or it's ultimately building only, building for commercial use? So, point number 7. If there is a building, in Infosys has this, and one lake or a pond, just for beautification, they have a pond or a lake, mini lake, man-made lake. I told you everything will be forming part of building. Swimming pool, building. We'll have building, roads, culverts, ponds, lakes, etc. So this pond is a building. On the other hand, if I have various small ponds and I am into oyster farming, oyster, oyster, they eat that oyster also, and inside the oyster there will be a pearl farming. So I'm from a pearl manufacturer. The oyster has to go through various ponds with different soil. When the oyster is small, they'll put it in this. After some time, they'll shift it here. After some time, here. After some time, here. An entire science behind it. Now, this oyster farming, where I'll use the pearl, etc. Here, this pond, is it building? No. What is this pond there then? This will be obviously used as a plant and machinery. So just because it is a pond doesn't make it a building. Just because it is a pond doesn't make it a plant and machinery. It depends on the facts of the case. It depends on the function. The functional test is of utmost importance. Are you guys getting me? Yes or no, guys? Able to understand? Yes or no? Do you have any doubts? Online people? Okay. So it depends on the functional test. Is it applicable, not applicable, etc. Depends on the functional test, basically, nothing else. The functional test has to be applied. Whether it is a plant or not. Block of assets is for the entire group or different companies. In the sense, it depends on the pan, guys. If Reliance, one company has one pan, then all the assets of that particular company will come under block of assets. Reliance Industries Limited, it may have various businesses inside, don't mind. It may have multiple businesses, but all the assets will come under Reliance. Right? So it depends on what all the assets of that particular company. It depends on those things. So Reliance as such, Reliance Industries Limited will have multiple businesses. Some assets will be used in one business, some assets will be used in one business, but for income tax purposes, Reliance Industries under the same pan, everything will be under block of asset concept. That's what I'm trying to tell. Method of depreciation also we saw. Okay. Right. Here's all it is. As far the rate of depreciation is concerned, guys, rate very simple. Full rate of depreciation you will claim if the asset is put to use for greater than or equal to 180 days. Half rate of depreciation if the asset is put to use for less than 180 days. Is software separately a royalty? Yes. Computer is 40%, software is directly debited to P&L account. Right? More on the computer software in international taxation. The computer software can be various things where I'll purchase the software directly as an end user, then I can take it as the asset only. Otherwise, if I'm selling it to somebody, all those components are there, we'll see that later. But just for your knowledge, computer hardware 40%, computer software directly debit to P&L account. Got it? There are various components, we'll see that later. That is a international taxation royalty definition. They have changed the definition there. That's why it is impacting here. Here there is no change. It's same only. But there they have changed it. So I have to read both. That's why. So rate. Full rate of depreciation 180 days. Half rate of depreciation if asset is put to use for less than 180 days in the previous year. And half rate of depreciation. What is this 180 days? Very simple. For Finance Act 25 26. The Finance Act 25, the previous year will be 25-26, and the assessment year will be 26-27. 1st April 25 to 31st March 26. Is it a leap year? No. In February 26, that's not a leap year because it's not divisible by. Is it a leap year? No. Is it a leap year? Yes or no? Yes. 4 6 are 26, right? 4 6 are 26. 24 are not 26. I've added GST. Sorry. It is not a leap year. Leap year comes once in 4 years, no? It already came in 24. Next, it comes in 28 only, thankfully. It's not a leap year. So, the date will change for us. What is this 180 days? So, you see, it should be used for more than 180 days, it says, from the end of the financial year. So, in March, we have 31 days, February 28 days because it's not a leap year. January 31, December 31, November 30. This makes it 151 days. In October, 28 days you should take. So, gist of the story is if it is used on or after 4th October, half rate. If it is before 4th October, then full rate. Because it is greater than or equal to 180 days. So, just for your knowledge in the examination, if it is used before 4th October, full rate. If it is used on or after 4th October, half rate. Right? On or after 4th October, half rate. Before 4th October, full rate. That's all we need to look at it. On or after 4th October, half rate. Before 4th October, full rate. Correct? You see, this will be page number B16. Speaks about the written down value. Written down value of the block of assets of the immediately preceding previous year, less depreciation actually allowed in the immediately preceding previous year. WDV of the block at the beginning of the previous year, you'll get opening WDV. To that actual cost of assets acquired during the previous year. Put to use for 180 days or more, put to use for less than 180 days, acquired but not put to use. Put to use for 180 days or more, put to use for less than 180 days, acquired but not put to use. 180 days or more than 180 days, acquired but not put in. Total is this. This is what I gave you an example of my printer now. I've acquired it, but have I put to use? No. Less money is payable. Don't go by the name money is payable. It's actually money receivable. It's like money is payable to SSE. That's what the law maker means. Money is payable to the SSE. Here it is money is receivable in respect of any asset in the block which is sold, discarded, demolished, destroyed, together with the scrap value if any deletions during the year. Less WDV of the assets transferred in slump sale. You will see this in capital gain. Entire business if it is sold as slump sale, this will come. Then WDV for the purpose of depreciation. Less depreciation. The prescribed percentage actually allowed. Then you have the closing value of the block. WDV assets, less depreciation actually allowed. WDV of the block, add actual cost of the assets, less money is payable. Less WDV of assets transferred in slump sale. WDV for the purpose of depreciation, less depreciation, closing value of the block. So you see this? 4th October, already discussed. Point number 5, you see. It's not so relevant now, but still it's there. Just go through. I'll explain. While computing the WDV of the block of assets as on 1/4/2020, that is for the previous year 2021, the goodwill of the business was already part of the block. Then actual cost of the goodwill reduced by the amount of depreciation that would have been allowable to the C for such goodwill, as if it were the only asset in the block, has to be reduced. I told you in the year 2021, if in the block goodwill is already included, I should exclude the goodwill portion. Now, how will I calculate the goodwill portion? I should take goodwill from the year of acquisition, one as if it was there. No other asset was there that time. I should take that and keep on subtracting the depreciation. And whatever balance I'll get, that will be my WDV. Example. See, opening WDV as on this thing. Here you see this WDV of goodwill calculated as if goodwill was the only asset in the block. In the intangible asset block, I should separately calculate the goodwill from year 1 and then remove that WDV, because this is only in the year 2021, mind you. That's why I said now it is irrelevant, but you never know if any question comes from that, okay, it is already included, you should exclude that. One example we'll solve here, you see. In 2018-19, Mr. X purchased intangible asset consisting of goodwill and patents for 20 lakhs. Goodwill was purchased for 10 lakhs, you see. You see, opening WD of 1819, nil, purchase 20 lakh, less money is payable, WDV for depreciation 5%. Closing WDV as on 1819 is 15 lakh. Then opening WDV of the block for 1920, 15. At actual cost, nil. Money is payable nil. WDV for depreciation 15. Less depreciation for 19, 20, 25%. So closing WDV for this is this much. But WDV of goodwill as if it were the only asset in the block, 10 lakh. Minus depreciation of 25%, 25% I should do only for goodwill as if it was the only asset in the block. That is 5,62,500. So this 11,25,000 includes 5,62,500, assuming goodwill was a separate asset. In this calculation, it is 11.25 lakh. But if I had taken goodwill separately only from 1819, 10 lakh I purchased it for. 1819, 25% gone. 1920, 25% gone. So how much will be left with? 5 lakh 62 500. Will be left with 5 lakh 62 500. So opening WDV 11.25 lakh. At actual cost of assets acquired in the previous year nil. Less money is payable nil. WDV of goodwill I should remove. Once I remove WDV of goodwill, what will remain? The WDV for depreciation. And there will be depreciation for 1819 at the rate of 25%. 1.40625 lakh. And what is the closing WDV? 4.21875 lakh. Closing WDV will be 4.21875 lakh. Simple. Opening WDV, cost of asset, money is payable, WDV of goodwill, WDV for depreciation. Got it? This 11.25 lakh has a component of 5.625 lakh. I have to remove from there. Did you understand this concept? It is old concept. But in case in one of the questions they ask you, you should remember. Yes or no, guys, all of you? Please let me know. Tell me, guys. Ramya, what about you? Soumya, what about you? Okay. If you see there, interesting point of depreciation is this one. Put to use for 180 days or more, full rate of depreciation. Put to use for less than 180 days, half rate depreciation. Not put to use, no depreciation. See example. Here, page B18. Plant and machinery at 15% depreciation at an opening WDV of rupees 1000. New plant and machinery for 500 at 15% was purchased on 15th March 22. The new asset was used only for 16 days only. When was it purchased? 15th March 22. 15th March 22 to 31st March 22 is just 16 days. The new asset was purchased only for 16 days. But still, will I get the half rate of depreciation? Yes. In this case, even though the asset was used only for 16 days, depreciation will be allowed at half rate. Opening block 1000, at purchases used for 180 is nil, less than 180 is 500. Sale is also nil. But guys, I understanding this 500 rupees you will get at 7.5% even though it was used only for 15 days. Yes, Ramya, you're right. Previous year 2021. Shakti is asking what happens with the goodwill after that. Nothing. It will be taken as what? Separately in the books. No treatment. For income tax purposes, no treatment. That's all. No depreciation. So you just remove it. See, income tax books is different from financial books. In financial books, can you claim depreciation? Yes. Companies Act, can you claim depreciation? Yes. That's why one of the difference between Companies Act depreciation and income tax depreciation is also this, apart from the rate. It will be ignored. That's all. For income tax purposes, ignore it. That's all. Nothing else. No change. No change whatsoever. Asset loose for less than 180 days. 500 into 7.5% is 37.5. Balance 1000 into 15%, 150. Total depreciation is 187.5. Thousand five hundred minus 37.5 minus 150 will overall become 132.15. Even though I use it only for 15 days, the best part is I'm getting half rate depreciation, 7.5%. On the other hand, this one, part of plant and machinery was sold on 1st March. Since it is sold on 1st March, it has been used for 11 months. Still, I will not get any depreciation because depreciation is calculated after the sale value. So even though I've used it for 11 months, I will not get any depreciation. I'll get depreciation only on the balance amount. So if you want to claim depreciation, it is always better not to dispose of any asset in March. You can dispose it in April, no problem, not in March. Got it? Plant and machinery of 15% depreciation and opening WDV of 1000. New plant and machinery of 500 at 15% was purchased on 15 March. Part of the plant and machinery was sold for 300 on 20th March. So 1500 was added, 1500, 300 was removed, total 1200 remains. Part of the plant and machinery, whether it's old or new, I don't care. This 1200 represents 500 new, 700 old. So for 500, I'll give half depreciation. For 700, I'll give full depreciation. So it says part of the plant and machinery was sold. The moment you come into the company, come into the block, asset loses its individual value. As simple as that. If in the above example, value of the asset sold was 1100 instead of 300. Now it's interesting. It was sold for 1100, guys. How much is left? Only 400 is left. This 400, will it be the new asset or old asset? Don't know because old asset is fully wiped out. No. New asset is 500. What is left only is 400, which means it is only the new asset. So I should give 400 into 7.5%. Are you guys understanding, all of you? Instead of 300, if it is sold of 1100, remaining is 400 only. But the new asset added only was 500. What is left only is 400, which means it is out of the new asset only which is added. So 400 into 7.5%. The asset was purchased in July of the relevant previous year. Let's say I buy it in July 2025 and put to use in December 2025. Will I get half rate or full rate? It is from the year it is put to use. December you put to use, hence half rate of depreciation. So you bought it in July 2025, put to use in December 25. Since it is put to use less than 180, you should take half rate. You bought it in March 25. Put to use in December 25. Bought it in March 25, put to use December 25. Half rate or full rate? Half rate or full rate, guys? Bought it in March 25, put to use December 25. Half rate or full rate? Tell me. Bought it in March 25, put to use December 25. Half rate or full rate? Yes, full rate. Why? Because it was not put to use in that previous year. The key word here is, that's what I'm coming to it. Keyword is what? Put to use in that previous year. So half rate or full rate? Full rate of depreciation I'll be getting. Number 6. Example number 6. The asset was purchased in July 21 but not put to use. Half rate is only for that previous year. You will get the full rate of depreciation. Right, guys?